Welcome to Morningstar. I'm Larissa Fernand, and with me today is Ben Carlson, the Director of Institutional Asset Management at Ritholtz Wealth Management, and also known for his fabulously insightful blog, A Wealth of Common Sense. Ben, I am thrilled to be talking to you today. It's a dream come true. Thank you.
Welcome. Glad to be here.
So, Ben, in your posts, I find that you rely heavily on historical data, but data is very objective, data is very unemotional. How do you cross this line when you invest as an investor, when you bring your biases and emotions to the table?
Yeah, that's a great point because I do like to look at history because I think it gives you a good range and idea of the outcomes that are possible. I think it's impossible to predict what the returns are going to be in the future, but looking at past data can let you know what the risks are going to be and the fact that everything is cyclical. So I think it's helpful from that perspective. But Warren Buffett has this quote where he said, if past history was all that was needed to play this game, the richest people would be librarians, right? And so there's this idea that just because you know what happened in the past doesn't mean you can predict the future, but I think you can still plan for the future based on the probabilities of the past. And you're right, it is easy to have your biases be part of that data because you can do a back test that looks beautiful and torture the data and make it look like anything that you want it to look like. But you also have to behave and follow a strategy in times when something can look very easy on a chart. You see these little squiggly lines in the past that could have been this brutal bear market. And so I think behavior trumps all when it comes to the data like that. It's much easier to behave when looking at a back test or looking at a chart or some strategy in the past for how great it performed. But how are you going to react when something doesn't go as planned in the future? Because the future is never exactly like the past.
So, have you been very emotional in your investments? Have there been any biases that you've had to really contend with?
I think we all have our biases. And I think the hard part is you can read all these wonderful books about behavioral finance and behavioral psychology and list off the 20 biggest biases that we all have. But the problem is we all have our own blind spots. And I think everyone has their own different type of bias, right? Some people are far too emotional. Some people don't have enough emotion. Some people overreact. Some people underreact. I think a lot of it depends on your own personality and makeup. And I think that's why for most people, the strategy that you can stick with that fits your personality type is almost as important as anything. So yeah, I'm sure I have plenty of my own blind spots. I'm sure sometimes I'm a little too optimistic about things. Some people would say that things are going to get better and the long run is going to work out. And it's possible I'll be proven wrong about that someday. But yeah, I think every investor has their own blind spot. So I think that's why one of the most important things as an investor is just knowing and understanding yourself and where your emotional weak spots are so you can try to make good decisions ahead of time.
So, give me a weak spot that you have or a personality trait that works in your favor, a blind spot and a temperament that works for you.
I guess I never really get too high or too low on things. And I think that's true both in my investing and in my life. And sometimes it's a good thing and a bad thing, right? Sometimes my wife says maybe I'm not enthusiastic enough about certain things because I try to keep a steady pace. And I think sometimes you do have to allow yourself to understand when things have changed. And so maybe it's kind of like a strength and a weakness that I don't really get too high or too low about things. And that's just kind of my personality. I've always been a glasses half full kind of guy. And I think that's fine because most of the time things work out well in the end, but there are times when things go bad. So I think you have to understand that while there's been plenty of progress and markets tend to work over the long term, in the short term, there's going to be hiccups and there's going to be problems. There's going to be crashes and recessions and all these things. So even if you have an optimistic bent about you, like I do, you have to understand the fact that bad things can and will happen when it comes to the financial markets.
Has there ever been an investment where you went with your gut feel or instinct and it backfired? Has there been many instances like that? Or are you a
Oh,
numbers
oh,
guy?
sure. Yeah, no, I'm generally a numbers kind of guy, but I've had my share of I've tried to pick stocks in the past and it didn't work out very well because I know this company or I think I understand it or I use the products and I should just buy it because it makes sense. Excuse me. So I've had plenty of those, and that's one of the reasons I've more or less retired from stock picking because I just realized that I don't have the personality traits to pick individual stocks like that. Now I know a lot of people do, but for me that it just hasn't worked out very well in the past. And I know that I'm not a very good stock picker. And so that's one of the things is admitting to myself that I'm just not very good at this. So maybe I shouldn't do it.
Wow, that's quite a humbling I mean, that's quite a humbling observation to make.
Well, yeah, and I think that that's tough for a lot of people because most people are probably overconfident in their own abilities, and if especially in the markets, if something goes wrong, it's really easy to blame something else. Like I would have been right if it wasn't for the Fed, or if it wasn't for interest rates, or it wasn't for the economy, or whatever it is. So it's hard to look yourself in the mirror and say, well, maybe the reason that I lost money on this trade or this investment is not all these other external factors. It's because that I just didn't know what I was doing or I made a mistake. And I think that's hard for people to admit. And it's not like I realized this right away. It took me a while. And I think that self-awareness is something as an investor that's important to be able to understand, like, this is what I'm decent or good at, and this is what I'm really not good at, and try to separate those two things.
So, in your evolution as an investor, how would you describe yourself as an investor today, as against what you were, say, 20 years ago?
I've always been a long-term investor. That whole mindset and idea has always resonated with me. My early educators in terms of books and such were John Bogle and Warren Buffett, and those ideas of thinking and acting for the long term, that the light bulb went off pretty early for me, of understanding that I have decades and decades ahead of me to invest, especially if my money is in the stock market. So I should think and act for the long term. And so that's always been my ethos of investing. I think that markets generally work over the long term. I think costs are very important. So you should keep them low. I don't think it's possible for most people to predict the future, but I think it does help to analyze the present and the past to calculate probabilities. And I'm more of an evidence-based investor over someone who pays attention to excitement and fads. And I think durability in investment process is the most important thing. So I've always said that a good investment strategy you can stick with is vastly superior to a great strategy that you can't stick with. So I do think that behavior trumps all. So for me, what that means is I try to make good decisions ahead of time. So I automate as much of my investing process as I can, because I don't want any emotions coming out in the heat of the battle when there is a bear market or there's a crazy bull market or bubble or something. So I try to automate as much as I can to make those good decisions ahead of time and just get out of my own way.
And do these principles of yours overspill into your personal life, into your relationships, into your regular day-to-day?
Yeah, I think the way that works is I think it's important to have a decision-making framework for investing and then for other parts of your life. So I generally think that I have an idea of how the world generally works, or how the markets generally work, and then I apply that framework to whatever's going on at the moment. Because, right, like I said, every environment and every cycle is different, and I think that's the same way to think about making decisions in life. So I'm a big process over outcomes guy. I think that it makes sense to make good decisions with the evidence you have at the time, with the understanding that sometimes even taking all the information you have and making a decision, sometimes you're going to be wrong or things are going to go against you. And I don't think that necessarily means you have to change your decision-making framework. I think the more good decisions you make, the higher your probabilities are for success. And I think that thinking of that process versus outcomes and understanding that sometimes you're going to fail, quote unquote, even when you make good decisions, but that doesn't mean that you should give up on a decision-making framework that works for you. So that's how I try to think about it in life too, is just making good decisions and thinking in terms of so I always tell my kids, I have some young kids, 3 kids under the age of 10, they're playing a bunch of sports these days. And I always tell them before they have their games, I don't care if you win or lose. I don't care if you score any points or make any baskets or make any goals. I just care that you try your best and have fun, and then whatever happens, happens. And so don't focus so much on the outcome of the game and how many points you're going to score or if you're going to win or lose. Focus on like the process of the game and playing it right. And that's the kind of way I try to make my decisions as well.
When you talk of outcomes, focusing on the process, how have you evolved in your relationship with loss? When despite following the process, you incur a loss?
It's definitely something I've changed my tune on. When I was younger, the losses stung a lot more, and there is the behavioral economics idea of loss aversion, that losses sting twice as bad as gains make us feel good. That's the Daniel Kahneman idea. And I think it's true in most aspects of life, whether it's losing money or it's losing a game or something like that. And uh, so early on, even when I didn't have a lot of money to put to work in the markets, seeing the portfolio value drop, it really stung. And it took me a number of years to realize, especially as a younger investor, when I was in my 20s and early 30s, that if I'm investing in the stock market for the long term, and that means decades and not years, and I'm a saver. I'm someone who's saving out of every paycheck. I save on a weekly, monthly, quarterly basis, on a regular basis. That uh, when I see losses in the market, that's actually a good thing. So I had to change the framework in my head to be like, actually prices going down is good because that means I can buy shares at a lower price and higher dividend yields and lower valuations. And I kind of learned to lean into that pain and actually change the way I thought about bear markets of, oh, when I'm a younger investor and I'm still saving and I'm a net saver for years to come, bear markets are actually a good thing. And I think that's very difficult for people to wrap their head around because they just assume, listen, I see red, I see the value of my portfolio going down. This has to be a bad thing.
What makes you such a critical thinker? What skills have you honed to come to this position?
I thank you for that. I appreciate that. I think part of it is reading and learning from people who are smarter than me. I was never someone in school who was like a straight A student. I would always get B's and B pluses, but I had to really work for it. And so I've always I never thought I had a lot of natural intelligence. So I really tried to fill some of those gaps by reading a lot. And I read all the time and I read people who are smarter than me. I read different opinions. I try to get my analysis from as many sources as I can. And I think one of the ways to do that is to have a good filter because there's a fire hose of information available these days that you can get your opinions and analysis from so many different sources. And there's 24-hour financial media and there's social media and there's newsletters and there's all these different places that you can get news and analysis from today, which is a wonderful thing for investors. But it can also be overwhelming if you don't have the right filter in place because you can get information overload. So I think part of it is understanding and knowing the sources of information. I think I've done a good job of doing that, and also again just having some self awareness that there's always going to be people smarter than you, and so I think when it comes to investing, you have to understand that like your emotional intelligence is way more important than your IQ or your actual intelligence in your head. And I think that's something that I've realized over time is that I've known plenty of really smart people who could probably, lap me on an IQ test, but might not be able to invest because they can't control their emotions.
Name one or two investors you would love to spend time with.
I'm a big proponent of never meet your heroes because I feel like if you read a lot of the books about these people, the biographies and stuff, you come away with thinking like, man, that person did make some wonderful investments, but other parts of their life had to suffer because they were working so hard. So I guess a lot of the heroes that I've known throughout investing, I don't know if I'd really want to meet many of them. One of them that I actually did meet in person that lived up to the expectations, and I think my favorite writer in all of investing is William Bernstein, who's written the books The Four Pillars of Investing and The Ages of Investors, and he's probably written close to 10 books now. And I got to meet with him and spend a day with him, and the reason that I really love his style of investing, he's taught me more than just about anyone about investing over the years, is because he does look at the data. He's a former doctor, so he's very data driven, but he also marries that data with the behavioral side of things and understands that the data is useless if you don't have the behavior and the emotion and the temperament to be able to handle that. So that's someone that I've met and interacted with who has more than lived up to the expectations, and I highly recommend to people who haven't read any of his stuff.
You seem very evolved as an investor. Does anything make you insecure?
Oh, sure. I'm sure I get insecure a lot, especially if you're putting stuff out into the public. You have to develop a thick skin because there's always going to be people who disagree with you. That's what makes a market, right? If everyone agreed and used the same strategy and had the same thought process, then there wouldn't really be a market. There's always going to be conflicting opinions, and so every time I hit publish on my blog, I have a little bit of insecurity that does this make sense? Are people going to understand what I'm trying to do here? Are people going to like this? And there's been plenty of times of things that I've written where I've spent a lot of time on, and I thought this is going to be a post that's going to go crazy. People are going to read it. People are going to love it. and I get crickets kind of. But then there's these other posts I write where I have a thought and I write the whole thing in 15 minutes and it goes crazy and all these people are reading it. So I guess that's the life of a writer and a blogger. But I think everyone has some insecurities about, past regrets and hearing comments from people who maybe disagree with you. And I'm not necessarily a perfectionist, but I always think of like, yeah, could I have said or done something better than that? But the good news is no one is perfect. So I guess it's you never have to worry about living up to that standard.
You have a massive fan base in India. I know at least 2-3 people who told me to please reach out to you and talk to you because they wanted to listen to you. How do you keep your ego in check? How do you stay grounded?
Well, I appreciate that. And I do hear a lot of people from India who write me, and I always appreciate that. I'm just a normal guy, and I've always approached the markets from the idea of I'm a normal guy, and I wanted to simplify this stuff and speak in plain English. When I first started my blog, the whole point behind it was I had all this family and friends who were coming up to me and asking questions because, hey, Ben, you're the investing guy. Why don't you help us with the markets and understand it? And so I started my blog with them in mind. And I wanted to write for people to understand this stuff because when I was starting out in the finance world, everyone seemed to make everything so complex. And I just never understood, like, yeah, I get the markets are it's like a complex adaptive system, and the markets themselves are very complex if you want to understand like the inner workings and how they work. But I thought people made it more complex than it had to be. So I've always been a big proponent of less is more and simple over complex. And that's what I've tried to do in my writing. And a lot of times when I'm writing, I almost forget that there's someone on the other end that's reading it. Because a lot of it is for me personally, it's very helpful because there's this old saying that the reason that I write is to figure out what it is I actually think. And so I'm taking these jumbled thoughts in my head and I'm putting them down, and the whole writing process is helpful for that. And so that's the thing. And I think the other thing is that it's so easy to be wrong these days. And especially if you're writing on a regular basis, putting stuff out, occasionally you're going to be wrong, or someone's going to come back to you with a different piece of data that disproves something that you've written. And that's an interesting part about it too, is that it's an easy way to stay humbled because I get so much good feedback from people who are reading me and saying, have you thought about this? Or did you look at this piece of data or this study? And that feedback is humbling and also very helpful.
I go back to the incident where you spoke about your children. You tell them to focus on the process, not the outcome so much. Would you consider yourself to be a very successful investor or a successful individual?
The way that I measure success as an investor for people is really, a lot of people, there's so many different metrics that you can look at, right? Am I outperforming the market? Am I staying in line with the market? What are my risk adjusted returns? All these different ways. And the way that I look at success for investors is, are you on the path to achieving your financial goals? Because I think that's the biggest thing for everyone, right? Am I going to achieve my financial goals? Not, am I doing better than my neighbor? Are my portfolio, my stock picks doing better than them? I think that stuff can really trip investors up. So for me, it's, am I on track to achieve my financial goals? And I am. So I would consider myself a successful investor. Now, if I look at my returns, I'm sure I could say, like, if I would have just done A, B, and C, my returns could have been way better. If I wouldn't have invested in this and I would have doubled down on this instead. But I think that's really easy to with the benefit of hindsight, to go back through and, like, that's the only perfect portfolio there is looking back historically, right? No one knows what the perfect portfolio or optimized portfolio is going forward. So as someone who is a diversified investor, and I invest globally, I invest in different asset classes, there's always going to be something in your portfolio when you're diversified that is going to hold you back or look like, why did I do that, right? And there's this guy, Brian Portnoy, one of my friends, who always says that diversification means always saying you're sorry, right? And so I could look back and say, like, my returns would have been so much better if I just didn't have these two pieces in, or this one piece or whatever. But that's not the point of diversifying in the first place. It's a risk control. So yeah, I am on track to achieve my financial goals, and I think that's the only thing that matters. That the returns or the alpha or the outperformance and stuff, that kind of stuff doesn't matter to me at all, as long as I'm happy with my current financial situation.
And my final question to you is, when you look at your evolution as an investor, is there any trait you wish you knew then when you started off that you know today, or any regret that you wish you had started off differently?
Yeah, I think a lot of investors will tell you this. So I've probably been investing for close to 20 years now. I think most people who get along in age a little bit will tell you that, especially when you're young, the thing that matters most is not really, your stock picks or your investing or your timing the market and all these things. The things that people think are exciting, it's really your personal finances, right? You're saving, developing good habits for saving, living on less than you make, these types of things. And I think if you focus too much on the markets and investing when you're young, it can kind of, it's not nearly as important. Now, the investing piece matters. You have to save and compound your money, but the personal finance stuff, I think, matters way more than the portfolio, especially when you're first starting out. And the stuff with the markets, I think you can figure that out later as long as you develop those good savings habits first.
So I think it was wonderful talking to you, Ben, and I really appreciate your time. Thank you so much.
Thanks for having me. This was great.
Yeah. This is Larissa from Morningstar. Thank you for watching.